Today we have Graham McKenzie, Managing Director of Exchange Traded Products at TMX Group, and Alfred Lee, Director, Portfolio Manager and Investment Strategist at BMO ETFs, with us today in the studio to talk about trends in the ETF market in Canada for 2024 and beyond. Thank you for being here with us today, Graham. Alfred, good to see you. So to kick things off, Graham, why don't we start with you? Let's talk a little bit about some of the flows and trading activity that we saw in the Canadian marketplace in 2023.
Yeah, so last year, 2023, was really a robust year for Canadian ETFs. We saw more than 100 new ETFs get launched in Canada, and there was really a lot of new money that went into ETFs. We saw about $38 billion of net new flows into Canadian ETFs. Of that, probably about essentially $13 billion went into equity funds. And from there, we saw the vast majority of that money, or most of that money, was split between going into Canadian ETFs and international ETFs. What was surprising was less than $1 billion went into US ETFs, which is really different from what we've seen in the past. We also saw flows into, from an equity perspective, $3.5 billion went into covered call ETFs, which is an area where we continue to see growth. On the fixed income side, we saw $21 billion go into fixed income ETFs. And of that, it's really important to probably split those up, because $9 billion of that $21 billion went into sort of money market or cash ETFs. So the remaining $12 billion was, Canadian investors put them further out the curve. On the alternative space, there was roughly just under $2 billion that went into that, with $1 billion of that going into crypto ETFs, taking advantage of sort of the spike in the rebound that we saw in the crypto space last year. The more traditional liquid alts came in with just under $1 billion of new flows. You asked about trading flows or essentially liquidity in the Canadian market. Volumes were down last year, and on the ETF front, volumes were down about 19% as far as the amount of activity that was happening day to day. That's sort of on par with what we saw in the general market, which were down about 18%. But again, ETFs, flows, launches, everything along those lines were really quite strong.
Thanks, Graham. Alfred, what about you? What do you see happening in 2024 the same way as it happened in 2023, and what do you see as going differently going forward?
I think there's going to be a lot of trends that are going to be persistent in 2024. But at the same time, I think there's going to be a lot of new trends that emerge as well. So, to Graham's point, fixed income was extremely popular in 2023, making up about 2/3 of the flows, I believe. But when you look at fixed income and you compare it to, a fixed income ETF, the underlying fixed income market has a lot of challenges. I mean, it's an inventory-based market. Bid-offer spreads are wide. It's not a whole lot of transparency. And, when you try to go and buy a bond and add to that position a couple months later, it's sometimes challenging, right? So when you buy a fixed income ETF, it addresses all of these shortcomings. So, when you look at a fixed income ETF, you compare it to the underlying market. It's almost as if you're looking at better technology, right? Not to date myself, but it's a little bit like comparing streaming services to a VHS player, right? So I think that's one trend that's going to persist. Sector-based ETFs were also very popular with investors. So I think, when you look at ETFs to provide exposure to Canadian banks, technology, I think those are trends that are going to persist. In 2024, I think what's going to change is factor-based ETFs. So factor-based ETFs, in my opinion, took a little bit of a step back last year. And the reason why is because I think, as Graham mentioned, a lot of investors were gun-shy coming into the year. But once they realized that the market was starting to rally, index-based ETFs or traditional-based ETFs were the easiest way to get exposure to the market. But now you look at 2024, a lot of mispricing in the market could happen just because of interest rate expectations. And depending on which way the market goes, certain factors could outperform the other. So I think as the year progresses, factor-based ETFs will be a good way for investors to reposition a portfolio, manage risk in a portfolio. And at the same time, I think, nonlinear ETFs and derivatives-based strategies will be popular with investors to manage risk in a portfolio as well.
And so we've talked a lot about, the last 10 years. Even if you think about the last 5 years, the ETF industry has changed and grown significantly, and ETFs have certainly brought a lot of innovation to the marketplace. They've been a game changer. They've brought really efficient access. So maybe each of you could provide a couple of examples of now ways that you can build a portfolio using ETFs that you were not able to do just 5 years ago. Graham?
Well, I think when you think of it from that perspective, I would say historically, as we know, ETFs really started and were predominantly beta products. And even though, say, actively managed and different usage of ETFs has been around for more than the last 5 years, it's certainly accelerated in the last 5 years. And we've seen even, for example, 60% or a significant portion of new ETFs are actively managed mandates. So as you're building your portfolio, it's a lot easier to sort of build that core satellite type of portfolio now utilizing ETFs, because the range of decision or opportunities that you have for those, either thematic, sector, risk tools, factor products are all available for that satellite sleeve. So you can be a lot more tactical. You can get your beta as you've always been able to, but that sort of satellite investment strategy is really an opportunity now for people to manage risk and be tactical.
You have so much more choice.
Yeah.
Well, in my opinion, I think the changes to 81102, I think that is a big game changer in terms of what the ETF market could offer going forward. So for those that don't know, with the changes with 81102, that essentially allows ETF providers to essentially potentially use leverage in certain strategies, the ability to short securities in strategies as well. So I think, to Graham's point, I think in the past, ETFs have done a very good job in terms of, representing the 60-40 portfolio, so your traditional assets. I think where they've kind of fallen short in the past is that liquid alternatives part of the portfolio. So I think with the changes to 81102, the ETF industry is going to now be able to offer, new strategies that fit that certain part of the portfolio. And the other trend is that, as we've had conversations across the country with different advisors, different family offices, the common thing that comes up now is they're allocating more to alternative strategies. So I think, going forward, I think it's going to be exciting to see what the ETF industry offers collectively in terms of new products. I think what the Canadian ETF industry has always proven is that it's always innovative. But on top of that, it's not just innovation, but it's also practical solutions that can be used in portfolio construction.
And I like to remind people that the ETF business started here in Canada, so we put ETF innovation on the map. Yeah. Well, thank you, Alfred. Thank you, Graham, both of you, for sharing your thoughts and insights with us today. Always a pleasure catching up with you.
Great. Thanks, Nikki.
With us in the studio today, we have Rob Morocco. Rob is head of ETF listings at Cboe Global Markets, as well as Chris McCaney, director and lead portfolio manager on BMO's derivative-based ETFs. Today, our theme is looking stateside, and we'll be having a closer look at trends in the US-listed ETF markets. Welcome, Rob and Chris. Thank you for being here with us today.
Happy to be here.
So Rob, let's kick this off with you. What were some of the trends and some of the flows that you saw in the US ETF marketplace in 2023?
2023 continues to just show the resiliency of the product. We saw 500 new ETFs come to market in the US. Of the 500 new products, and when we look at the flows of what we've seen, we've noticed, no surprise, the majority of new flows going into equity ETFs, next up fixed income, much smaller alts. But when we look at the diversity of the new products coming to market, one key underlying theme has been products that have embedded optionality and derivatives within the portfolio. So I think when we continue to look forward to this year, that trend definitely continues only to grow and only to innovate.
Now, I'd like to ask the next question to both of you. What do you see continuing in terms of trends in 2024, and what do you see being different this coming year? We'll start with you, Chris.
Sure. And so, I think looking forward, probably one of the things that's going to continue is the outsized flows into fixed income. Fixed income, 20% of AUM, but received about a third of the flows last year, which makes sense as yields continue to move. But I think the other thing that's going to continue, and Rob mentioned it, is the flows into covered call ETFs and option overlay ETFs in specifically. We're used to this here in Canada. We've had covered call ETFs since 2011, but it's a relatively new phenomenon in the US. We've seen most of the flows come in the last couple of years. Right now, covered call ETFs are about 1% of equity AUM in the US, whereas it's about 7% up here in Canada. So I would look to see that trend continue in the US and catch up to what we see here in Canada.
What about you, Rob? Any thoughts to add there?
I think when we look at, as Chris pointed out, some of the newer products, and when I say newer, over the last 24 to 36 months, the buffer protected and defined outcome, target outcome like products in the US, we saw in 2023 those products top out at $35 billion in AUM in that particular product set. So I think, and we're only in the first innings, and knowing that there's already been such great adoption here north of the border in Canada into products with optionality, and to Chris's point, still a small percentage of overall AUM in the US. So that's where I see that we're still clearly, there's a bit of education that needs to continue on with these products. How do these products work? How should a portfolio manager think about implementation for a client? But when we look at Canada, and the fact that there has already been that education phase with the covered call and the use and the adoption, when I look at the now products that we've begun to work with BMO on buffered and accelerated products, it's ripe for this next iteration of innovation with this product set.
Thanks, Rob. So when we're looking at trends in the US ETF marketplace, how does this relate to Canadian buyers? What are some of the differences between the US and the Canadian ETF marketplace? Chris, maybe you can answer that for us.
Yeah, I mean, usually what you see is the innovation start in the US, and that comes eventually north of the border, with a 3 to 5 year lag typically. We've mentioned covered calls actually being the opposite effect. And I think the other thing that follows that is crypto-based ETFs, right? So you asked one thing that might be different coming forward as well this year, and that's obviously in the US now. Crypto-based ETFs have been given the go-ahead, whereas we've seen that already here in Canada for a number of years. So I think the active space and the sort of non-traditional asset space has flourished here in Canada already. So that's kind of some of the differences you see relative to what we're seeing in the US, where that's really just starting to get underway now.
Now, when buying ETFs that focus on the US, what are some additional key considerations for Canadian investors? Let's stay with you for this one.
Sure, and maybe we'll start with saying, we're not tax experts, so of course everyone please consult your own tax advice. But what I would say as a good rule of thumb for Canadian investors is that in general, if you're considering a US listed ETF or a Canadian listed ETF that provides that same exposure in the same way, generally a Canadian investor would be better off owning that Canadian listed ETF. And it really comes down to the fact that an ETF listed in Canada for tax purposes is considered Canadian property, whereas a US listed ETF is considered US property. It doesn't matter what's in that ETF, that's just how it's considered. And so for Canadian investors, if you are buying US listed ETFs, you are accumulating US property, and that could have implications for your taxes. It could be simply just filing an additional piece of tax return in Canada. It could mean filing a US tax return, whether you owe taxes or not. So there's that administration aspect. And then for high net worth investors, it could mean things like US estate tax as well. So there are a few considerations to have. When we're talking about accessing international markets, there's extra withholding tax if you go through the US as well. So again, in general, it's preferred for Canadian investors to buy Canadian listed ETFs.
Now, Rob, if you could expand a little more on some of the innovations we've seen in the US ETF marketplace over the last little while, what should we be watching for here in Canada?
Sure, and I think Chris was great preamble into really where we see some trends going both sides of the border, coming down from Canada. Canada had the first ETF, as much as we like to say, with the first ETF in the US being SPY. There was a predecessor here in Canada, and same again around products with optionality. I think when we look to 24 already, this year's come in roaring in with the launch of spot Bitcoin products in the US. We just did that last week on our US market. those products have been trading for some time already in Canada. I think what we look to 24 and what's in front of the regulator, the applications now to launch other types of digital asset ETFs. So that will be interesting to watch and see what happens there, and if innovation does continue to grow. I think just like anything else, and maybe last point on digital asset ETFs for the moment. Yes, great. We've hit this milestone in the US that has allowed for spot Bitcoin ETFs. The next iteration of those products, we already see the filings coming into the SEC. Covered call products on top of Bitcoin. So you can clearly see where there has been adoption, regardless of asset class, whether it's been on equities, whether it's been on fixed income, with an overarching optionality strategy embedded within the ETF. I see that only continuing to grow, not only in terms of assets, but number of new products and products that look different. We've seen now, I'll say, pretty generic buffered products on the S&P 500, on the NASDAQ 100, and so on and so forth. I think now you'll see products 2.0 coming to market. And so this is where I think just a bit more sophistication and innovation within some of these strategies.
Thank you, Rob. And Chris, what about you? Anything to add to that in terms of innovations that maybe started in the US, but we're starting to see here in the Canadian marketplace?
Yeah, I think those buffer ETFs are actually a great example. Even in the US, they're relatively new. Most of the AUM in those funds has come in the last couple of years. And so I think it's really early days for those type of strategies, even in the US. And so, certainly at BMO, with our expertise in option overlay strategies, we're happy to bring those structures here to Canada for Canadian investors, built here in Canada for Canadians. And I think that is only going to continue, again, both in the US and in Canada.
So definitely building on our expertise as the largest options ETF house in Canada, with those buffers and accelerators, definitely something to watch for as we build out our suite there. Thank you, Rob, and thank you, Chris, for being here with us today. That is a wrap for our session on ETF trends stateside.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.